we'd like to talk a little bit about this concept in the not-for-profit arena that if you are a 501c organization, you have to deal with the issue that we have to avoid something called private inurement, which is a really funny word, but the concept is that no individual or no shareholder should benefit specifically from our net earnings or our activities. So we do various things in order to avoid that situation. This can lead to, if we have abuse in this area, it can lead to a loss of tax-exempt status. But the Internal Revenue Service, sometimes to serve the greater good and to maintain tax-exempt status, it's not a good idea to revoke a tax-exempt status for these type of errors or problems. So they brought in intermediate sanctions. Okay, so it's basically an excise tax or a little bit of a punishment when we have these sort of situations, as opposed to revoking tax-exempt status. This commonly referred to as private inurement, excess benefits, but at the end of the day, what it really means is that the organization is delivering an economic benefit or substance to a person or an individual that's really more than it should be. So they're benefiting from the not-for-profit's activities. So that's something that's frowned upon by the service and something that we have to pay close attention to in these organizations.
It would probably help to, I think, identify who those types of people are. And the technical word for it is a disqualified person. Again, another fancy word from the IRS, but it really deals with anyone that can exert influence over the operations, the administration, or the finances over the organization. Typical people would be officers, CEOs, CFOs, board members, but it also extends beyond that to their family members. And also to any organization that they would have at least a 35% interest in. So if you have a landscaping company that you're contracting with and you own 50% of it, and they have the contract with the not-for-profit, you're at risk to be defined as a disqualified person, and that company is as well. It begs the question, how do we avoid these types of transactions and these types of issues and not get caught in a trap that maybe we weren't aware of? First and foremost, good governance is the most important thing. Establishing policies around conflicts of interest, around compensation packages, and you have to look at the entire package when it comes to executive compensation. So not just base salary and typical insurance benefit plan benefits, but also beyond into some of the things, auto allowances and those kind of things. You have to look at that entire package for reasonableness, because it's not only each individual benefit that they're going to take a look at, but the whole package, whether it's reasonable in comparison to executives at like-size organizations. So policies and procedures, conflicts of interest, address those, and also follow up on them. Measure them every year, monitor them, and assess where you are as an organization in regards to all benefits provided to anyone who might be a disqualified person.
Absolutely.